Hey there, I'm Nick from Income Digs. Welcome to this video tutorial where today I'm going to talk through a really cool strategy in QuickBooks Online for dealing with those rental properties that you purchase, potentially with hard money or a private loan, then you renovate them, and then you refinance, okay? I'm gonna go through that whole process from the purchase all the way to the refinance. Maybe that purchase with hard money isn't something that you specifically do, but this refinance part is going to work for any kind of loan. So even if you have a conventional loan, even on just a property that's performing just fine and you wanna refinance it, what we're gonna do in QuickBooks today is going to cover that for you, all right? So what we're gonna do is we're gonna work with a phantom transaction, again, from purchase all the way through renovation and refinance. So what I have here is my QuickBooks Online setup, and this is actually my first video I'm doing with the new user interface with this gray section over here. I think it looks pretty slick. We'll see how it works to make sure everything's going well. I don't own this property yet in my book, so if I pull up my balance sheet, I won't have it in there yet, okay? And I'm gonna be using classes to differentiate between my properties. And the property I'm gonna purchase is this one right here, the 701 Main Street. Okay, I'm gonna be purchasing it. This is a sample closing statement for $140,000. I have some closing costs. And I'm ultimately getting a hard money loan for $185,000. And they're going to be keeping some of that in escrow. Okay, so I'm gonna show you how to deal with that. So the first thing we're gonna do is record this purchase transaction. So what I'm gonna do is get both of my screens kind of in the same general area so we can look at both at once. Okay, so I have my closing statement over here to the left. So what I'm going to do is give myself a little bit more room. Actually, I need this because I'm going to do a journal entry. Okay, for the purchase of property, if you haven't seen the videos that I have on this yet, I'm almost always doing a journal entry. That way I can make sure that I record everything in great detail. Okay, so 9/1/2019, the date of the journal entry is going to be the date of the closing. So the first thing I'm going to do is record that I have this building. Now, you're probably going to have to differentiate between buildings and land, and you should have some kind of way of doing that. Discuss that with your accountant, your CPA. For now, I'm going to say that $120,000 of this purchase is for the building. One more zero. And 20,000 is for land. I'm going to skip this stuff for now. I'll fill it in a second. Okay, so I'm purchasing that, and what I like to do when I kind of start with the asset, okay, and then I do owe money in taxes as well. Okay, so I can do property tax as an expense. Okay. So $450 there. And then another one for school tax. Okay. Now this is a really simple closing statement. I acknowledge that. So I owe that much to the seller. Then I also need to pay some of these other fees as well. Okay. So the recording fees, I typically put those, now those are closing costs, right? So the taxes you're going to take in that year, the purchase closing costs you may want to depreciate, in which case you're going to go to your balance sheet. So I'm going to take the recording fees there. I'm going to take the title insurance, the survey. Now, if you're not sure of where your closing costs should go, talk through it with your CPA, but in general, now this one is closing costs as well. In general, pretty much anything that's not taxes or interest is going to be something that you put toward the basis of your property and then you depreciate it. Okay. Now, I'm just going to go through and write these descriptions real quick so I have them. And the idea with writing these descriptions, you want to be able to pull up this journal entry and really mirror it with the closing statement. There shouldn't really be any differences between them. Think about if you come back to this in a year or two, like, are you going to remember what happened? You want to, kind of leaving yourself some notes as to what you were up to. Okay, so I'm at this $143,599. That's how much I owe. But how much cash am I bringing to the table? Am I going to pay all that with cash? No, I'm not. I'm going to be getting a loan. And this is going to be a hard money loan. Okay, so now where does this go? This is obviously going to be a liability, but where should it go in your accounts? I think I have a section for it. I actually don't. I'm going to do a hard money loans account. Now you don't have to do this. You can just treat it as you would your other long-term liabilities. Notes payable, hard money loans. Looks good. Save and close that. So I'm getting a loan for $185,000. That's going to hit my balance sheet. Now I'm not getting all that cash right up front. So let's see here. So what I'm going to do, I also have to pay my lender's fees as well. So I have a mortgage tax. So I'm going to do that as a closing cost as well. Okay. Recording fees. I'm sorry. Closing costs. Investor attorney fees. Okay. Now I also have this construction escrow. So what this means is that I'm not going to be getting this cash at closing or anything. They're going to be putting it into an escrow account that I can use later. Okay. And do I have a construction escrow? I don't think so. Let's see. Nope, I have a tax and insurance one. Let's do that. Let's do a construction escrow. And what this is kind of a, it's like an other current asset because it is yours. You're paying interest on the loan. The loan balance is there. So let's do other current assets. This is kind of like prepaid expenses, construction escrow right there. And I'm putting $45,000 into it. And then the last line item on this whole thing is going to be the money that's coming out of my checking account, which is the $5,124, and this is just cash due at closing. All right, now before I save and close this, I just want to add the classes to make sure that I have all that. And this is going to be a new class because it's a new property that I don't yet own. Ooh. New business. Whoops. Let me just save this. And the whole screen's kind of messed up right now, so I'm going to come back to it. All right, so I purchased that property. It's just a big screen, that's all. So now I'm just going to copy these down. Okay, so there we have all my classes are filled in. Now I can save and close this. All right, so looking at my balance sheet, if I were to take my balance sheet and then filter it by just the new class that I created, which is at 701 Main Street, you can see everything's going to fill in there. I have my construction escrow, I have my land, my buildings, my purchase closing costs, and then my hard money loan as well, okay? So now what I'm going to do is I'm going to renovate my property, okay? So you're going to be tracking expenses, and I suggest you use the products and services to do that, and you're going to be adding value to your property through the money that you spend, the capital improvements. So what do I mean by products and services? If you've seen some of my other videos, I have some specifically on this. If you use products and services within your QuickBooks account, it not only gives you the ability to be more detailed in where you spend your money on Capex, but it also automatically maps to the right accounts. So what I have in my products and services is a bunch of kind of rehab categories as their products and services, but they're tagged as items that I purchase, and that you can see when I pull them up, I'm able to automatically put them into an expense account. Okay, so the expense account I'm putting them into is Capex. All right. So we can use these in our expenses. And again, if you haven't seen this before, check out the video that I have specifically on it. If you're in my real estate accounting bootcamp, you're definitely going to see this. And I actually provide to you the import to get my same, the same categories here. What I'm going to do is I'm going to create a few expenses so that we can add value to the property. Okay. So let's say that this comes from my checking account. And here is where I'm not going to use category. I'm going to use item details. And say, for example, I do rough electric, and maybe I spend $15,000, and I put in 701 Main. I can save and close that. And let me take that, I'm just going to copy it so I can get a few of these kind of quick here. All right, so now I have another 9.1. Let's do like 9.15. Instead of rough electric, let's do rough plumbing. Maybe this is for subcontractors and I'm paying like $8,000. But then I have another one for rough plumbing where I'm getting materials, right? So you do a separate line item there. And this could be $567.50, something like that. The other advantage of using products and services, as I'm going to show you how you can pull the report, is if you're you're depreciating this stuff, your accountant might ask you, where did you spend the money on the rehab? And you want to be able to answer that because different expenditures have different depreciation schedules. For example, appliances, if you're spending money on appliances, that could have a different, potentially a 5-year depreciation schedule, right? Okay, so I'm spending all this money. Now, right now, it's all coming out of my own account. I haven't used anything from the escrow yet. But the idea would be that once you reach a point to get a draw, you could draw out of that escrow account. So let's see what my balance sheet looks like right now. So if I pull up that balance sheet, and let's again customize this to just be for 701 Main Street. Okay, so here you see that I've spent $35,000 on my Capex. I'm going to save this report just so I have it. Okay, so I've spent this money. Now, when I talk about being able to drill down, they all go right here because I've mapped them already, those products and services. But what's super cool about this is I can click into this, drill down, and then instead of organizing it by the account, I could group by product or service. And when I run that report, look at how it gives me rough plumbing total, rough electrical total, and appliances total, all right? And you can see how that's going to give you so much great information to share with your accountant, right? Let me do one more for interior. Let me just copy appliances, and let's do like kitchen cabinets. What do I have here? I think I might just have a kitchen one, sure. Okay, and let's say I spent another $11,500 there. Save and close it. Okay, it'll show up there, and now I can see too, like I can bring these up and down. I can see that I spent $23,000 in rough structure and $23,000 in interior. I spent $47,000. All right, that's a pretty cool way to do it. And again, if you want to see that in more detail, we have specific videos on that. If you're in Real Estate and Accounting Bootcamp, I know that you are covered with it. All right, so there's where I spent that money. Now, I haven't touched the escrow yet. Now, at some point in time, it probably makes sense where I would talk to the lender and say, hey, I've done some work. Maybe it's when you finish, but it's probably at a few points in between, and you would want to distribute some of that money. Okay, so how do we do that? We can do a journal entry, of course, where let's say it's like in the middle of October or so, or maybe it's just at the end of the renovation altogether, okay? Where you're saying that escrow, that construction escrow, you're going to be taking the money out of there, the $45,000. It's a draw. And then you're putting it into your checking account. They're paying you, okay? Now, they could also pay your subcontractors directly. That's possible as well. But in this case, you're kind of covering the expenses and they're paying you back. Of course, if you can't really afford the expenses, that the arrangement might not work, or maybe they just have to be in shorter increments, 15,000, 3 times as opposed to 45,000 once. So I can save and close this, and now that will show up on my balance sheet as well. I've emptied out the construction escrow. I've got more money in my checking account, and all in all, my property's worth, per my books, $190,000. All right, you with me so far? We've purchased the property, and we've gotten the loan taken care of. We've done the renovation. We've gotten a draw from our lender, okay? And now we're going to refinance, okay? The lender maybe is in there, just you're paying interest only. We haven't recorded those expenses yet, but those are easy enough. But now would be the time that you're going to refinance. So how do we deal with that situation? Well, what we do is we do a new journal entry as of the refinance date. So I'm currently on 12/4/2019. So let's say that is the date. And this is relatively easy, but it can be confusing. You're probably going to get a closing statement that's kind of all over the place. Now, I don't have one of those to show, but we can talk through some of what's going to happen. The first thing I like to do is whenever you have a complicated journal entry, you know one thing for sure. You know that hard money loan of $185,000 is going to be paid off, right? You know that for sure. So you can take your hard money loan, okay, and we're going to debit it that $185,000 because it's going away. Okay, so refinance. All right. Now, how much is your new loan worth? This is another case where start with what you know. So you saw my book values with $190,000. They probably care more about the market value, and they're probably doing a loan to value. But it's possible that you can get a loan for a lot higher than that. Let's in fact say that we're getting a loan for $270,000. Now, for conventional loans, I typically have a couple different items here. First, this is a first position loan, so I'm going to do 270. Refinance that property. Okay, so that's great news. Now you could say that I'm going to be getting $85,000 in cash. That's not necessarily what's going to happen. We'll probably have some closing expenses. Okay. And how do you deal with these closing expenses? You would probably put them toward your same purchase account. If you want to create a separate one, you can. But what I mean by that is you're going to do a title search again, right? So it would go similarly as a closing cost, $990 title search. Okay, you probably have a transfer tax. And so that would be a, $1,200 transfer tax, something like that. You're certainly going to have attorney fees. Now, should you separate those out into different categories? You can. I don't see the need to, as long as you're kind of writing them as a description. You don't want to muddle up and have a gigantic balance sheet, a gigantic P&L. It doesn't really help anybody. You want to be able to quickly get the information you need. Okay? Maybe there's points on this thing. So maybe you'd be putting your interests. You'd be putting maybe $2,700. Maybe it's 1% origination fee. Notice that interest is COGS, whereas the cost of goods sold, where the rest are going to my balance sheet. And that's typically how it works. Again, talk to your CPA about it. But those items that are going to be expenses and deducted in that calendar year would typically go on your P&L. And let's say that's it. If it is, that means that I get a check from this bank of $79,560. So that refi really went well for me. Obviously, a lot easier said than done when it's a sample one, but you would take that cash and potentially invest in a new property. So that's why that strategy can work. And what I'll do here is I'll just take a second again to put in my classes, and then we'll see what it looks like on the balance sheet. Okay, so there we are with all our classes. I can click Save and Close. And let's see what this does to my balance sheet. Okay, so I get cash in the bank. And that's okay. So this is not as of the right date, and that's why I was a little confused. So let's make it as of today, run that report. I have cash in the bank. I still own the building. My purchase costs have gone up. My building basis is still the same. But now I have this conventional loan, and the hard money loan's gone, and then some of my expenses were put in there. Okay? And that's really how you deal with that whole situation. Purchase with hard money, do the renovation, take a draw or two or three, and then eventually refinance the entire project and then rent it out. Okay, it's a really cool strategy. It's kind of the value-added rental strategy that we use a lot as well. So thanks so much for sticking with me on that. I know it was pretty complicated, but if you have specific questions on this scenario, put them right in the comments, and then we'll have some follow-ups on it. We've been getting a lot of requests for stuff like this, so I was really happy to get this one out. And as always, feel free to check out all the free resources available on incomedigs.com. If you are interested in learning information like this in a more structured manner, you are more than welcome to check out Real Estate Accounting Bootcamp. It's an amazing course that we have available. We're getting some really great feedback from the students who are in it already. All right, until next time, enjoy QuickBooks, enjoy all the software that you are using, and we'll see you on the next video.